Hello, my name is Kyle McLean, and I'm a partner and senior wealth manager here with Rame & Gurrell Wealth Management. Today, we're going to be talking about a unique tax strategy for high earners, the Backdoor Roth IRA. If you or someone you know could benefit from this strategy or the other services that our firm offers, feel free to contact our team for a complimentary consultation where we will review your financial situation to determine opportunities for optimization from an investment, tax, estate planning, employer benefits, and retirement strategy perspective. Before we get started with this tax strategy, let's review IRAs at a high level. The Individual Retirement Account, or IRA for short, is a type of tax-advantaged investment account created by Congress to help individuals save for retirement. These accounts can hold many types of investments, including stocks, bonds, mutual funds, ETFs, and much more. All IRAs have tax advantages, but it's important to understand the differences between the two most common, the traditional IRA and the Roth IRA. The key difference between a traditional and a Roth IRA is taxation. In a traditional IRA, a deduction is generally available for the contribution of assets, and all taxation is delayed until assets are withdrawn, often decades later. As an alternative, in a Roth IRA, there is no deduction up front. Taxes are paid on funds before they may be contributed to the account. However, distributions in retirement are generally tax-free, including on any growth that has occurred. With this in mind, who should focus on a pre-tax traditional IRA contribution and who should focus on a Roth IRA contribution? It really boils down to the current versus future tax rate for that investor. If your current tax rate is lower than the rate at which funds would be distributed from the IRA at a later date, you might want to make a Roth contribution, since you'd rather pay your current lower tax rate and receive tax-free growth. If your current rate of taxation is higher than the rate at which funds would be distributed at a later date, pre-tax contributions could be better, which would encourage you to make a traditional IRA contribution if a deduction is available. There are also differences in eligibility for contributions to these types of accounts. For 2024, once a single individual has a modified adjusted gross income above $87,000, or a married individual exceeds $143,000, they cannot deduct a traditional IRA contribution if they also have access to a 401k or similar employer plan. For Roth IRAs, contributions are entirely disallowed for single individuals with a modified adjusted gross income over $161,000 and married individuals with a modified adjusted gross income over $240,000. The lack of deduction for a traditional IRA contribution and a moratorium on Roth IRA contributions above certain income levels is really what brings the Backdoor Roth IRA into play. Here's how it works. A contribution to a traditional IRA is made when the individual is above the deduction limit for a traditional IRA contribution, as well as above the limit for a Roth IRA contribution from an income perspective. This means that no deduction is received for the traditional IRA contribution, but the individual cannot place the money directly into their Roth IRA. Subsequently, the non-deductible funds in the traditional IRA are converted to their Roth IRA. Although there is a moratorium on Roth IRA contributions, conversions remain allowed at any level of income. Just as funds directly contributed to a Roth IRA receive the benefits of tax deferral and tax-free distributions, so do assets that have gone through the Roth conversion process from a traditional IRA. As long as future distributions are qualified under IRS rules, 100% of the Roth IRA balance will be distributed tax-free. In addition to tax-free growth and distribution, other benefits of the Roth IRA assets are available. For instance, Roth IRA funds are not subject to required minimum distribution rules upon reaching age 73, as traditional IRA assets are. Furthermore, Roth distributions are not counted as income when income is assessed for determining things like Medicare premiums, which rise at certain levels of income. Roth distributions also will not put you over the income threshold for the 3.8% Medicare surtax on investment or earned income over certain limits. Let's consider an example for our friend Bob. Bob is married, he participates in his company 401k plan, and he has a modified adjusted gross income of $250,000. This means that he is over the limit for income in order to make a deductible traditional IRA contribution or a Roth IRA contribution at all. Without the Backdoor Roth IRA, the next best place for him to save would have to be his brokerage account, where gains are not deferred, they're taxable in the year that they occur. The Backdoor Roth IRA allows Bob to divert his funds that otherwise would be placed into that taxable brokerage account into his Roth IRA, where his gains will be tax-free in perpetuity, even though he's over the limit for the direct Roth IRA contribution. Again, Bob would make a non-deductible contribution to his traditional IRA. Subsequently, he would convert those non-deductible dollars over to his Roth IRA. This is a tax-free transaction. Finally, he'll enjoy the long-term tax-advantaged growth and tax-free distribution of these Roth IRA assets. Additionally, since Bob's married, his wife can also take advantage of a spousal Backdoor Roth IRA, which doubles the available savings amount from $7,000 for somebody who's under the age of 50 to $14,000 as a married couple. While it's not as significant as some 401k contribution limits, the Backdoor Roth IRA amounts add up over time, and they're a nice addition to the tax optimization toolkit for those preparing for retirement. Now, let's talk a little bit about how the Backdoor Roth IRA is reported for tax purposes. As a result of the conversion, investors will receive a 1099-R document from their custodian that indicates that a conversion or distribution from a traditional IRA has occurred. Making sure that you or your CPA correctly reflects this transaction on your Form 8606 of your tax return is critical. This is how you tell the IRS that a conversion event should not be taxed. This brings us to one of the most common pitfalls investors face when performing a Backdoor Roth IRA transaction. Again, the Form 8606 is how the investor tells the IRS what percentage of the conversion from traditional IRA to Roth IRA is tax-free. When an investor transfers $7,000 to their $0 balance traditional IRA account as a non-deductible contribution, now 100% of this traditional IRA balance is non-deductible. Therefore, 100% of the conversion to the Roth IRA is subsequently tax-free. But what if they already had $7,000 in their traditional IRA that had been rolled over from a prior 401k? Now, only $7,000 or 50% of the total $14,000 balance in the traditional IRA is non-deductible. On the Form 8606, this would result in 50% of the conversion to Roth being tax-free. This is known as the pro rata rule. In short, the pro rata rule causes problems with Roth IRA conversions when the investor has prior IRA balances that originate from a pre-tax source. This can be from pre-tax balances in a prior 401k, or simply contributions that were made before the investor went above the deduction income limit. Carefully review your investments for pre-tax IRA balances prior to making any Roth conversion decisions. As you can tell, the Backdoor Roth IRA is a complex transaction that must take into consideration various income limitations as well as IRS rules. However, if approached properly, this strategy can supercharge tax-advantaged savings for those who are already maxing out their 401k. As a team, Raymond Gorell Wealth Management serves 400 families across the United States, as well as expats abroad, with over $1 billion in client portfolios under advisement. As a firm, we strive to serve as an effective one-stop shop for comprehensive retirement planning. If you'd like to meet with one of our CPA, CFP, CIMA, or CFA professionals for a complimentary consultation, please reach out to us using our phone number, sending us an email, or visiting our website today.